aye as well. Let's do some example questions for a change rather than just pounding you with rules and stuff. Let's say we have a new corporation, CCPC. What makes it a CCPC?
Private.
What does private mean?
Not public.
Not public, right?
Canadian controlled and
Meaning,
not controlled by non-residents.
beautiful. So private corporation, not public. Public means one that's traded on a public stock exchange. So private corporation, which is not controlled by non-residents. We've got a new CCPC. In its first year, it earns $100,000 of active business income. It's owned by an individual. Here's our company, $100,000 active business income. And $30,000 of interest income. I'll tell you that the corporation is not associated with any other corporations or anything like that, so it's got full access to the $500,000 as regards active business income. Its taxable capital is way below $10 million, awesome. And as you can see, it's earned less than $50,000 of SIB income, thus there's no reduction in its small business deduction entitlement as regards earning too much SIB income. You okay so far? So a very clean situation, and we're going to calculate what the tax payable by this company is. Now as to rates, and I always need to tell you rates. As to rates for today, for this discussion, let's go to page 428 in the textbook. So these will be our active business rates. I'm going to leave these on the screen because we're going to need another set of rates for the SIB income. I'll ask you to turn there in the textbook, but in the meantime I'll leave this on the screen so that you've got two sets of rates open to you. And in fact, since we're not dealing with a public corporation or with high rate active business income, we'll just go straight to the bottom of the page. Where would we find a good example in the textbook as regards SIB? I would go to that one where it starts with $1,000 worth of, this is in chapter 13, $1,000 worth of SIB income, which would be this one, page 499. So I'm going to leave this open right now to page 428, and please leave yours open to 499. And we'll do active business income first. $100,000 of active business income. Page 428. I like this rate for this question. We'll use 13%. $100,000 times 13% is $13,000 tax on active business income. Under what part of the act? Which?
Part one.
Part one. Our SIB rate, now go to page 499. Is it 499? %, and 10 2/3%, 50 2/3%. 30,000 times 50 2/3%. Anybody can do that math faster than I can? I bet you all can. 30 times decimal 50666. I got $15,200. How's that? I would appreciate if somebody could check my math though. 50 2/3% times 30K. Thank you.
Yeah.
Total tax, whatever the total of this is, $18,200. Way we go, file tax returns, done like that. Step 2. Same corporation pays in the following taxation year a $27,000 dividend. $27,000 following taxation year. First of all, we know that this is what's called a taxable dividend because no part of it is a capital dividend. Capital dividend is something Leo touched on last week. It's the non-taxable portion of a capital gain if this company had had a taxable capital gain, which it hasn't because it's not part of the facts. Therefore, we know that the full amount of this dividend is taxable. Thus, this person happens to be an individual because I drew a circle. This person has to pay tax on the full amount of the dividend, whether it's eligible or non-eligible. By the way, what's your guess as to whether it's eligible or non-eligible?
Part eligible, part non-eligible?
Part,
Eligible, part non-eligible?
tell me more about that.
Because you can only pay eligible out of stuff you didn't take the small business deduction on.
Almost. Just going to repeat that. So, hypothesis is part eligible, part non-eligible, because eligible dividends are amounts that you didn't pay, you didn't get the small business deduction on, which would be that side, right? Actually, eligible dividends are dividends that were subject to the high rate active business income. Or in the case of a public corporation, any income at all. So back to page 428. Income that was taxed at the high rate, that is the general rate, 72% of that income goes into the GRIP. A dividend that gets paid, a taxable dividend that gets paid and designated as having come out of the GRIP, that's an eligible dividend. My guess, and I think it's a pretty good one, is that this will all be a non-eligible dividend going up here to this person, non-eligible. The question though, I'm going to ask you is what amount of dividend refund does this corporation get for having paid a $27,000 dividend? Let us go to page 499. See where it says potential refund when dividends are paid, 307? taking my pen and I'm writing there, and I would invite you to do the same in yours. Dividend refund. That's an actual thing, dividend refund. I'm kind of surprised that the textbook didn't actually use those words. I wish they had. And if you can mar your textbook more prettily than I did, that'd be awesome. Dividend refund. So at the outset, the corporation, this one, paid 50 2/3% tax. In our case, the tax is $15,200 on $30,000, so just a little bit more than half of this income got paid in tax. And you'll find this total is $507, representing the equivalent of this. But there's a potential refund when the dividend is paid of, in this case, $307. And in this case, 30 2/3% of our SIB income. So if I take side calculation over here, $30,000 times 30 2/3%. I get some number, let's calculate. 9,200? Mind if I check your math? Sounds pretty good though. I mean, I'm not sure I need a calculator for that. Beautiful. This 9,200 is like this 307. That's the potential dividend refund that's available to us as long as we pay out enough taxable dividend. And if we pay out an infinite amount of taxable dividend, well, which we can't because we don't have an infinite amount of earnings in the first place, we get back $9,200. If we pay out less than an infinite amount, our dividend refund is $9,200 times a smaller amount that I want to show you exactly where it says in the textbook. Please bear with me. The amount is the amount of dividend that we pay, $27,000 times 38 1/3%. This is the second or third time we've seen this 38 1/3%. And by the end of today's lecture, I'll solve the mystery about why we're seeing it so often and sort of where it comes from. But in the meantime, take my word for it that the amount of dividend refund that we're going to get is $27,000 times 38 1/3. The lesser of this amount, and how much potential dividend refund we've got waiting for us based on this calculation. So, this thing here, you can imagine it filling a box where this $9,200 goes into the box, called refundable dividend tax on hand, something else that Leo referenced last week. I'm explaining now what it's all about. So just like 72% of GRIP, general rate income goes into a box called GRIP, 30 2/3% of SIB income goes to a box called refundable dividend tax on hand. And right now, inside the box is $9,200. And our dividend refund is either 27,000 times 38 1/3%. Please do that math for me.
10,350.
10,350. The lesser of that amount, and whatever's in the RDTOH box in the first place, that's our dividend refund. Our dividend refund is $9,200. This is an actual refund to the company. Let's assume that in year 2, which is the year that this dividend's being paid, the company has exactly zero income, so it pays zero tax. Honest to goodness, CRA would write a check back to the company for $9,200. I kid you not. So you can think of it like an actual refund, like opening the mail. Clicking on your bank account, $9,200 sitting there. Because the company paid a large enough taxable dividend such that the lesser of the two amounts to which it was eligible, 10,350, which is 30 1/3%, and 9,200, the amount by which we filled up the RDTOH bucket in the first place. $9,200 dividend refund. Now the 9,200 has been used up, it comes out of the RDTOH box, and we hopefully maybe have some SIB income in year 2, in which case we'll replenish it. And as I said before, no part of the income of this company was taxed at the general rate, thus zero went into the GRIP, at least in the first year. If this company, say in year 2, had active business income of $600,000, 100,000 times 72% would go in the GRIP bucket, because 100,000 would be represented by general rate income. Any questions so far? Let's go back to here. Potential refund when dividend is paid and amount available for dividend. So let's say that this company is also a new company, and its first year, all it made was $1,000 worth of SIB income. And at the end of the first year, it's got $493 worth of, actually, let's say cash in the bank. Because it earned $1,000 of income, interest, let's say, paid a bunch of tax, got $493 in the bank. First day of year 2, director says, I'd like to pay a dividend, but kind of all we got is $493. If I figure out how much dividend refund the company's entitled to, can I include that amount in the dividend? You know, if I pay enough dividend? And the answer is yes. We can pay this dividend on day 2 of the new year, even though we didn't actually get this equivalent of $9,200 back yet. Oh, well, how much are we entitled to? Well, our RDTOH is 30 2/3%, or $307. Oh, well, hopefully then, we'll get the whole 307 back. So I can pay a dividend of $4.93, which I have right now in the bank as cash, and $307, which I have promised to pay from CRA. That's a total of $800. Let's declare an $800 dividend, which they do. And then here's the math. Lesser of lesser of? Right now, inside the RDTOH, we have 30 2/3% of $1,000, and we're paying a dividend of 800. So we take 800 times 38 1/3%. Somebody tell me what that is? You'll love this. It's exactly $307-ish.
307, exactly, if you round it.
So my dividend refund is the lesser of 307 and 307. My dividend refund is 307. Some things in tax are mind-blowing to me, and this is one about how this thing exactly works out. And 30 1/3, I still haven't told you where that came from yet, but 30 2/3% is exactly the right number to allow us to flush out in year 2 all of the retained earnings, including the dividend refund we haven't even applied for yet, but will, and enjoy a dividend refund based on this 38 1/3 calculation. Yes?
Will they always be exactly the same number? And then if they are, why is it the lesser of the two? Why not just use one?
They will only be the same if the company only earns SIB income and pays out to the penny all of its retained earnings, after-tax earnings, in this case $493 plus whatever. That'll happen like almost never. So 99.x% of the time, it'll be you have to do this lesser of calculation to see what's what. You okay so far? Any questions? I'm happy to go as slowly as we need to. Except I've had coffee, so if I'm speaking more quickly than usual. I think you can slow down the video if you have to. So the lesson from this so far, calculating tax, you sort of separate the different types of tax, you apply the rates, calculate the tax. RDTOH, you fill that with 30 2/3% of the SIB income goes into here. And then later, and it may not happen in year 2, it may be in year 6. You pay a taxable dividend, you do the lesser of calculation to figure out how much your dividend refund is for the corporation. This refundable, special refundable tax here, 10 2/3%, which is all part of this cabal of 30 and point something and 38 point something. This 10 2/3%, we call that refundable Part 1 tax. I'm going to go on to another example using same corporation. Here's the next example. $30,000 worth of interest income. We're going to replace that with $30,000 capital gain. Difference between business income and capital gain income. Would anybody like to comment on that? Because, I mean, obviously both arise from a profit. I sold something for more than I paid for it. I keep trying to remember that that's the right thing for investing. I always get that backwards. The difference as regards capital gains, I really like Leo's analogy, which I think was a tree and fruit, so tree and apple. If I sell the tree, that's a capital gain. If I sell my business, if I sell my machine, these are all things that give that the employment of those creates income. So business creates income, a tree creates income, a machine creates income. If I sell the tree, capital gain all day long. If I sell the apples, that's an income. That's active business income. And tax jurisprudence liberally uses the tree versus fruit analogy. Turn with me briefly to chapter 5. Well, let's get a read on your own time. This business income versus capital article. And one reason why it's really important for lawyers is because there's a rebuttable presumption that if somebody is expert in a given thing, like for example, if you're a real estate lawyer and you're expert on real estate, do a lot of consulting and documenting of real estate transactions. There's a presumption, rebuttable, that if you personally buy real estate, like for example, if you buy a strip mall or an apartment building or something, that it's more likely than not that you may have bought it to profit on the eventual sale of that building. Because you know so much about the market that you know that you're buying well and sort of know when to sell and how long to hold on to and stuff like that. Thus, you may have bought this real estate to hold as inventory for resale, even though the real estate itself produces profit called rent. Now, the way to rebut that presumption is to say, look, I actually created a business plan that shows me renting this thing out for at least the next 5 years and making improvements. These are all things that that I'm doing that I would argue are inconsistent with me flipping the thing. Thus, I am actually buying a tree, not fruit. But I encourage you please to read this article on business income versus capital, because it's a gray issue, not well defined, not defined at all actually in the Income Tax Act, and has been the subject of court cases forever and will be forever. Because, as you may know, capital gains are only 1/2 taxable as compared to business income, which is fully taxable. So our corporation has $30,000 of capital gains and also $100,000 worth of active business income. No change here. The tax on the active business income in year one is $13,000. For year one, for the capital gain, it's as follows. Of the $30,000 capital gain, only $15,000 is included in income, because as I said before, capital gains are only half taxed. And it's taxed as SIB income, taxed in the same way as SIB income. In fact, it is not itself SIB income, because it's not income from a business which involves, or which implies activity. A capital gain is sort of the opposite. I bought something and I held on to it for a period of time. And you may see in the textbook might refer to aggregate investment income, or AII, which is the total of SIB income and taxable capital gains. So AII is SIB income and taxable capital gains. So this year, in same example, our SIB income is 0 and our taxable capital gains is $15,000. To this, we now apply the whole 50 2/3 and blah, 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 blah. So $15,000 times 50 2/3% is, if someone can help me with that, somewhere around $7,630.
Maybe 7,600?
Exactly $7,600. And here's the next question. How much of that goes into the RDTOH? Now you have the benefit of having your notes from the first question, so it's exactly 1/2 of the previous example. I don't have those, so I'm going to write it out. So into the RDTOH goes $15,000 aggregate investment income times 30 2/3%. And how much is that? $4,600,
Yep.
which by my memory is about half of 9,200 from last time. So it looks like my math is okay. $4,600 goes into there. So all we've done is changed up. SIB income became capital gain, half of which is taxable capital gain, taxed like SIB income. We call the total something else, apply the same math. Tax payable, RDTOH, looking for an opportunity to get broken out of jail and provide a dividend refund. Next year, the corporation pays a $27,000 dividend. Deja vu. Director says, okay, recall that if this was all SIB and active business income, the dividend would be a taxable dividend that is fully taxable to this person. But now, we have, instead of SIB income, a taxable capital gain. And we get to open another box called the capital dividend account. Leo spoke briefly about this last week. So this is a good thing, this is a good thing, and this is a good thing. We have money in these accounts, that's awesome. Because this can provide eligible dividends to individual shareholders, which you recall is a lower rate of tax for an individual shareholder. This can provide a dividend refund to the corporation. Again, good. And money going into the capital dividend account can be paid out tax-free to the shareholder. As a result of our capital gain, total capital gain of $30,000, the non-taxable portion, or $15,000, goes into here, into this box. And the director says to her lawyer, are you telling me that if I pay now, if the company pays a $27,000 dividend, $15,000 of this is tax-free to me? If the director is also the shareholder? Lawyer says, yeah. So of the total dividend of $27,000, $15,000 is a capital dividend that the shareholder receives tax-free. Because honestly, if the individual shareholder owned whatever it was this company sold, the company sold something and created a capital gain. Let's label that with this star. If instead this person, individual, owned that thing and had a capital gain, half of the capital gain would have been tax-free in her hands. So she wants to make sure that half tax-free in her hands thing is preserved if instead the corporation owns this and sells it and has a capital gain. So thank you, tax system that preserves that non-taxability of half the capital gain. So of this $27,000, $15,000 is a non-taxable to the shareholder capital dividend, and $12,000 is a taxable dividend. Eligible, non-eligible, whatever. In this case, non-eligible. Because you recall there's nothing in the grip box. Now we do the dividend refund calculation for the company. So now it is the lesser of the taxable dividend of $12,000 times 38 2/3%. I'm guessing that's about $4,600. $12,000 times 0.33333, not 666. By the way, that mistake, which I make often, that's a 0.5 mark mistake for you, thus not grievous. And as you'll find out, I'm also very generous with carry forward marks. If you make a mistake like this early in the question, cost you 0.5, say out of a 10 mark question, and you carry forward with these numbers, you only get penalized once. Just 12,000 times 38 1/3%.
2,600?
$4,600. So our dividend refund is the lesser of $4,600 and $4,600. By the way, I did not reverse engineer this question to get that result, and I'm hoping that it's correct, and I'm going to have a closer look at it. After I answer this question, following which we'll go for break. Yes?
Where did that 1,500 at the top come from?
This is 15,000.
Yeah.
It's the taxable part, it's the taxable portion of the capital gain. It's the taxable capital gain. And just to walk through it again, 15,000 times 30.23, 30 2/3%, decimal 30666. $4,600 went into the RDTOH bucket. And now we're taking out the amount of taxable dividend, or the lesser of $4,600, and $12,000 times 38 1/3%. And creepy, but I love tax, and it's awesome. So the dividend refund to the company is $4,600. Yes?
I know when Leo was talking about like the current trend and like what you're seeing in tax planning, and he said capital gains and transactions like this are becoming more common. Is that because they're getting they're getting both like that dividend refund and the amount that, like half of the taxable income completely tax-free, they get like the double.
That's correct. So if planners are saying, well, I got 2 or 3 different tax rates I want to work with here, got a particular transaction, I'd prefer to have that transaction be taxed as a capital gain versus active or anything like that, all because of the fact that A, it's only half taxable, and B, the corporation gets a big wacky dividend refund. And where this comes up most is when a corporation has a business, corporation wants to sell the business, and the shareholder says, well, maybe instead of selling the business, which will give rise to active business income, as well as capital gains, we'll explore that later in the course, maybe I'll just sell my shares, because my shares will only be a capital gain transaction, and I'll have half of it non-taxable. Or maybe this is the company that's getting sold, referred to as OpCo, operating company. I own it via my holding company, HoldCo. So this is the target being sold. Yeah, I'll be happy to have a capital gain in HoldCo, thank you, which will play out exactly like this, and ultimately with capital dividend account out to me and all the rest of it. And the only tax left payable in the company after the dividend refund has been paid is back to page 499. After the dividend has been paid, SIB income is taxed at 20%. Federal and provincial combined. So that after the dividends got paid, the dividend refund's been received, blah, blah, blah. That means that the capital gain, in this case $30,000, was subject to only 10% tax at the end of the day. Yeah, if I can structure something as a capital gain, that's a good day for me. Yeah. Thank you. Let's come back at 2:05.